We have breaking economic news. New gross domestic product numbers in the United States have just been released seconds ago. The headline number has come in meaningfully softer than expected. The gross domestic product number annualized quarter over quarter for the fourth quarter. This is a fourth quarter number, comes in at 2.3%. Economists polled by Bloomberg News were expecting a 2.6% advance in that figure. So 30 basis points is the difference between the figure being reported this morning of 2.3% economic growth in the U.S. in the fourth quarter versus the expectation of 2.6%. Personal consumption, however, has come in meaningfully stronger than expected. Growth in personal consumption, 4.2% in the fourth quarter, a full percentage point, 100 basis points stronger than the 3.2% expected by economists. The gross domestic product price index number comes in at 2.2%. That is weaker than the 2.5% expected by economists. We also have employment numbers. Initial jobless claims come in essentially in line with expectations at 207,000 new filings for jobless benefits in the United States for the week that ended on January 25th. Well, our next guest is Claudia Sahm. Claudia Sahm is a former U.S. Federal Reserve economist and founder of Sahm Consulting. And as you can see, she joins us now. Nathan Tuft, our featured guest, will be part of this conversation as well. Claudia, thank you very much for joining us. What are your thoughts on these numbers?
I think these are largely still very encouraging numbers. I mean, 2.3% is less than people had expected, and it is a step down from the past few quarters. But if you look big picture, and you really should across several quarters, I mean, the United States has been enjoying a very respectable growth rate over the past few years. And I think it is very important, as you point out, to look under the hood at what is driving the growth, and to see consumer spending coming in as strong as it is. That tells us something about how strong the economy is right now, and that says a lot about where we're headed as well.
Are these the kind of numbers that would encourage the U.S. Fed to cut interest rates?
These are still really good numbers. I mean, if you think the Federal Reserve, the median official thinks that the long run trend growth rate in the United States is 1.8%. Right. So a below 2% growth would still be a respectable growth rate. I mean, this is one quarter. These are noisy. There's reasons these bounce around. But a 2.3% growth rate, that's something that, we would be very happy with. I think, maybe we've gotten a little spoiled with getting, a run of 3% growth rates. That's very unusual. So I think this looks like actually for the Fed, this is a sustainable kind of growth rate.
Okay, I'll give the next question to Nathan Tuft. He is a portfolio manager at Manulife Investment Management. He's our featured guest this morning. Nathan?
Claudia, it's great to speak with you. What is your view on the potential distortions in these data, particularly given around policy uncertainty in the United States, potentially some front loading of imports into the U.S.? How dynamic is those distortions going to be as the year carries on, in your view?
Right. Well, I think, under the hood, some of the weakness coming in today is in some categories that typically are volatile, and one is in the contribution of net exports. And we did see, and we got this data just yesterday, that there was a big surge in imports in December. And it is possible that that is in part a reaction from uncertainty about the potential for tariffs, trying to get ahead of them, sourcing in goods ahead of time. And so, but if that's part of what's driving it, well, then that's not a persistent feature, right? That just means there's a timing shift in the resources coming into the country. And so I think uncertainty is going to, probably create some volatility in the categories. And that's why, in particular, I think it's often the case that it's very helpful with GDP to look at two of the main components, the consumer spending and the business fixed investment. So take out the inventories, which also I think did some probably damage today, and look at them as kind of the underlying pace. And those still look moderating on the investment side, but they both look still good.
Nathan and I had a good conversation about strength in the U.S. dollar just about 10 minutes or so ago. One of his views is that eventually, longer term, it may become a headwind to U.S. economic growth. Would you agree?
It's certainly possible that the dollar's a headwind to growth over long term. I mean, I wouldn't put that as like a key concern I have in terms of the slowing of U.S. growth, but it's, certainly in the mix.
Okay, talk to us more about how these numbers might look to the Fed.
So I think, these are advanced GDP numbers. They're our first estimate of the fourth quarter. They're going to look at this. Again, they look in particular what's consumer spending doing, what's business fixed investment doing. That looks good. Look at it over the year. This is the moderation. This is going to get you to a 4 quarter over 4 quarter growth rate that's really pretty close to the last projections that we saw from the Fed. Like, they've been expecting some moderation in growth. And I think there are features that have been driving U.S. growth, in particular on the supply side. We had a big increase in labor supply through population, immigration. That's reversing. We've had a lot of productivity growth that may not stick with us. So, things have been in an unusual space. I think the Fed looks at this and it's like, yeah, this is what we're expecting. And there's no alarm bells that go off with a 2.3% GDP growth, right? We want to get back to some semblance of normal. And to the Fed, this looks like some semblance of normal. So everything that Powell said yesterday about we are in no hurry, we're going to wait on the inflation data, that holds today. I think they probably will be happy to see, no upside surprise on the inflation numbers in the GDP data that we got today, and then we'll get the monthlies tomorrow. So I think all in all, this changes nothing from their, like, we're in a wait and see mode. We want to see inflation come down more, and then we'll act again.
Nathan, over to you.
Well, looking outside the U.S., it still shocks me just how many disappointments we're getting on GDP growth. Today, we got Germany disappointing, France disappointing. How long do you think this narrative can continue where the U.S. continues to push very high numbers, but the rest of the world just continues to disappoint?
So I think this year we in all likelihood will see some moderation in the U.S. numbers. The supply side of the U.S. economy maybe has been underappreciated in terms of how much we were able to push growth. I mean, we had very large population growth from immigration in recent years, and that pushed up overall. I mean, that helped support the labor market, helped push up overall spending, and that's reversing. Like, that has already begun to reverse late last year. So I think some of the factors that were unusual in the United States will unwind, but not in a going from unusually strong growth to stagnation like what we're seeing in Europe, right? There really was something fundamentally different about the way these economies came out of the pandemic crisis in the growth space. And I think, that's something to really dig into long-term policy discussion, because it gives the Fed and the policymakers so much more space by the fact that, the economy is in good shape.
Claudia, thank you so much for your insights this morning. That's Claudia Sahm, founder of Sahm Consulting and a